Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. What's up, homing pigeons? Guy Adami here, Dan Nathan there. Big day today. Might be the most important market call we ever do. Why, Dan? I'll tell you why. Because in a few minutes, we got Chris Verrone, my friend, Del Barton grad, a strategist partner, chief market strategist. That's a Baird company, by the way. Yeah. And of course, if it's Wednesday, Dan, yes, it's Butters, of course. So we got a little John Butters we're teeing up. How are you?
I'm doing great. I'm excited to have Chris. Chris is a fast money friend, not just a friend. So he's going to break some stuff down for us in the macro. It is a CME day, guys. So we got to look at some of the futures and some of the action that we've been seeing, because this has, been an interesting 4 or 5 trading days, the back and forth. And we've seen a lot of activity in the overnight sessions in the S&P futures. And I think that's something worth talking a little bit about, because when we've had this slow grind higher and the slow grind lower in the VIX, there just really hasn't been a lot of volatility in the in the overnight sessions, and part of that means that we haven't seen too many gaps one way or another, and that has been a change, at least in the last week or so.
Yep, agreed with that. Obviously, Friday was the day that we'll sort of go back to, but if you look at today with the S&P up, what do we have, about 70 handles or so. So if I had to do back of the envelope math, we're probably only down about 20 or so handles from what we saw on Friday, which is pretty remarkable comeback. And to your point, lack of volatility overnight is interesting. What I will tell you is also, to use the word interesting, is this continued move in gold that I'm sure Chris has some views on and we'll take a look at. But all these things sort of are part and parcel. It feels as though to me, Dan, just sort of reading the tea leaves, the market decided that the government shutdown will end at some point, and it's not market moving. And they're just looking past a slew of things that seemingly historically might prove to be headwinds. But now, people are focused on all the AI spend and all the AI deals. And, maybe that's enough. And on the heels of the bank earnings, which were good. I mean, we talked about that a couple of times. The earnings were fine. The valuations are concerning, but that's what the market is running with right now.
Well, there's another thing that investors don't seem to really care about is valuation. And I almost think that when we had that flush on Friday of a lot of the AI names, it had more to do with the crowding of the trade, right? It had more to do of adjustment in sentiment. It had something to do with the overboughtness of a lot of the names, given all those, announcements that we've seen. And, one thing I want to go back to is that, the government shutdown. I mean, there's a couple things. Maybe the numbers aren't huge, but furloughed workers are about 750,000, right? And if you don't think, and this is a period where we're not getting economic data, but if you don't think for a second that is ultimately going to weigh on consumer confidence, it's not just those 750,000 people. There's a lot of people in those orbits, whether they be family members, like a whole host of sorts of things you got to focus on. And then when you hear about the administration actually making actually firing people, even if it's 10,000 here or 5,000 there will be a whole host of government workers that have their, interests as it relates to consuming, suppressed, right? So these are all things that I think might be pushed out a little bit. Let's go to some of these bank CEO or CFO comments. Peter Bookvar of the Book Report, friend of ours, friend of the pod. He took some quotes out there. And I think, let's just go through this. I mean, JP Morgan, we've talked about this, where Jamie Dimon has been, I guess, a little bit cautious about the consumer for some time, but he said consumer and small businesses remain resilient. Credit metrics, including delinquencies, are stable and slightly better than expected, though the bank is watching for labor market softening, just like the Fed is. And they're talking about increasing reserves. And I think that, again, that obviously is a tone of caution. The U.S. economy, this is Citigroup, remains driven by consistent consumer spending and tech investment, and the consumer continuing support overall resilience despite cooling growth. Now, this is interesting, Guy, because I think it was Torsten Slok from Apollo a couple weeks ago talked about the growth in GDP. Most of it is coming from AI CapEx spend, and it's equaling the growth of, let's say, U.S. consumer, which we know makes up 2/3 of GDP spending. And then Wells Fargo saying the same thing, consumer resilience, yada, yada. Anything that you want to focus on out of these three large money centers?
JP Morgan's comments, CFO caution normalization could turn into deterioration if the economy weakens. I agree with that. I think everybody agrees with that. But again, talking about sort of the stress on the consumer and the labor market, I think those are all things that we've talked about for a while. I mean, to me, JP Morgan seems to have their finger on the pulse, not to suggest that Bank of America and Wells and Citigroup doesn't, but the story's a little bit different. Just in terms of stock stories, and we mentioned it last night on Fast Money. I mean, they all seemingly are looking at the same things. JP Morgan, to me, best in breed. They're getting rewarded that way in terms of valuation. Doug Cass points it out. But not only Doug Cass pointed out, Jamie Dimon pointed out that, they're not buying back stock because the company is expensive. Okay, fine. Citigroup has been a bit of a turnaround story. Jane Fraser's doing, I think, a great job. That's one bank we've liked for quite some time. The problem is, you've had a bank that's basically run from the low 60s, got to about 105 or so. So, you're probably right around fair value. Wells Fargo, to me, is getting out of the penalty box story. They were self-inflicted wounds for a long time. It's seemingly now the market is starting to reward them and re-rate them. Of course, the problem with them is, they're probably trading close to 2 times tangible book right now, which, maybe you get a couple turns higher, but not that much. So, 3 similar banks, 3 very different stories.
Yeah, 2 similar banks. One would be Goldman, the other being Morgan. Morgan reported this morning the stock is absolutely raging. It's up 6.5%. That's not generally what you see from an investment bank, where it's been telegraphed about asset management. It's been telegraphed about institutional trading, right? And obviously we know that the IPO window has opened up a bit, and we're starting to see some M&A activity. So to me, this one is a little surprising. This sort of strength. I don't know what you do with stocks like this that aren't trading cheap to their historical, that sort of thing. Let's pull up Goldman for a second here, and then we can kind of move on.
Goldman's, the British quote Goldman's.
But this thing looked exactly the same and was down, I think, 4% yesterday, closed on the highs, and here it is. It's just kind of meandering a little bit. But these are just sort of interesting juxtaposed to the money centers.
Which is typically, we've talked about Goldman. I think going into earnings, we said what's going to happen here, not that we have some crystal ball, but this is actually one we got right. I mean, Goldman typically runs in earnings, which it sort of did, and they usually sell it off in the wake of earnings, which is exactly what they did. And then you come back a week and a half, 2 weeks later, and then it's reaccelerated to the upside. And I don't think anything's necessarily changing. I think Morgan Stanley, if I had to guess, is just probably the beneficiary of reporting after Goldman Sachs, because the stock sold off yesterday and it's recouping some of those gains. I think Morgan Stanley made an all-time high today. So There you go, if I'm just sort of reading those tea leaves.
Yeah, breaking out. All right, let's do some macro here. We got a great guy to help us walk through some of these big moves that we're seeing here. That would be, there he is. There is Chris Verrone. He is a friend of ours, as we just said. We see him on Fast Money a whole heck of a lot. He's the chief market strategist at Strategas Guy, which is a
Baird company. He's also a partner there, which is, I'm very proud of him.
Yes, and we're going to talk a little bit about a ETF that he launched last year, because I think it's interesting. We get a really good window into his process. Chris Verrone, welcome to Market Call.
Dan, great to be here. Guy, great to see you as well.
Always.
Yeah. We, excuse me. I was at a concert last night.
Where'd you go? Oh, you went to see Mumford and his son, right?
Well, his son wasn't there. He does have kids, but I don't think they're kind of shaking the tambourine or anything like that. But it was an early morning for the Nathans. We had to get up from Philly, and we got to drive, as you would say, we jackassed it back to New York City. But here we are. Chris Verrone, you did not come here to listen to that, by the way, but you're probably a Mumford & Sons fan, I think.
Of course I am. I saw them back in March.
Okay. Yeah. Oh, did you go to the show at
the very intimate show, very small show out of Brooklyn? I forget the.
It was the Paramount Theater.
At the Paramount, great venue to see a show.
I was there also. That's a bummer we didn't bump into each other. All right, let's talk about the S&P. You've done some great work here, and for us, it's like, I don't know if you heard us talking about the ins and outs of just the last week. And, Friday was what it was, but the back and forth over the last few trading days is definitely sort of interesting. Just first, I just say, qualitatively, when you go from a low period of vol, now you're seeing the volatility bands widen very near an all-time high. Any thoughts about that before we look at the charts?
Well, Dan, I thought what you said earlier was important. Listen, when a market's quietly consolidating under the surface or lethargic under the surface, and that was really this index for the last 5 or 6 weeks, it could be anything that hits it. It happened to be a tweet on Friday morning, but I think you know as well as I know, if you look under the surface, the percent of stocks above their 20-day moving average had been deteriorating. The new highs were light. So it really could have been anything. I think it was more about a positioning shakeout than it was some real big kind of realignment to the status quo or to what's been kind of the overarching thesis of our call is that, hey, the status quo is still pretty good. I mean, consumer is okay. Banks are generally pretty decent. Credit's still benign. So this looked more like a positioning shake than it did anything else. But what I find really interesting on the other side, and here we are 3-4 days later, what index is at new highs and what's not, right? Russell 2 is the index at a new high right now. S&P is not. Qs are not. There's a leadership change kind of underway. We see it, Russell 2 versus S&P making 8-month relative highs. So this is starting to evolve a little bit in terms of what's driving this tape.
Fair. And I think part of that, and I think you would agree, first of all, Doug Katz has pointed this out. I know you probably agree. I don't think the IWM is the best constructed ETF. But with that said, what I think seems to be happening here, the lion's share or disproportionately small and regional banks. And what I think might be happening is there's this catch-up trade going on in the small and regional banks for a myriad of different reasons, not least of which the hope for M&A in the space, as we saw last week. So I think that might be driving this bust. But what I think doesn't matter. But you're right to point out there seems to be a bit of a changing of the guard. But let's look at the charts that you brought because these are fascinating. The first one, 20-day lows, 37% on Friday. Not a deep flush, but is it good enough? So walk us through.
Yeah, our thinking is when you're in a bull market, when you're in an uptrend, you typically don't need deep oversold conditions to get some response on the other side. And, what we always look for, 40, 45, 50% of the S&P making a 1-month low typically means you're pretty flushed. We didn't quite meet that threshold on Friday, but I thought we got close enough just given where we are seasonally. It's about the third week of October where seasonality turns up, particularly for cyclicals, particularly for small caps. So we kind of get that tailwind behind us over the next 8-10 weeks. And, Guy and Dan, you guys know, fourth quarter just tends to be good. So the expectation has to be that. I think the message or the signal is if 4Q actually defies what the typical seasonal pattern is. When you look historically, and you have a weak fourth quarter, what it really tells you is watch out in the first half of the next year. That is the message here. So, I look for seasonality to take hold and to rally this market to, 6,900, maybe 7,000. If we're wrong there, then I think we have bigger problems for first half 26.
Yeah. And, the first half of next year might only be interesting. And I'm sure, next time, maybe when you come on, we'll do a bunch of midterm year sort of performance, because I think that's something, listen, not that past performance is indicative of future performance, but it's always good to get a sense if there's any sort of patterns there.
Well, that's right. And there is. I mean, when you look historically, any given year, you'll have a 10, 12, 13% drawdown. Midterm years, it tends to be more meaningful. 17, 18% is the average drawdown in a midterm year. We've looked at this every midterm election back to the early 1950s. And the other thing you actually tend to see in midterm years, believe it or not, healthcare tends to be one of your best sectors. So if you're looking for what could be on the come here or what could change, healthcare in 2026 would be very consistent with the seasonal midterm cycle.
Let's take a look at the next chart because you talked about seasonality. Yeah. We'll take a look at this. The long-term capital one after this is fascinating, but walk us through the next couple.
Yeah, I mean, what we're just showing you here is when you look seasonally, going back to say 1950 and say, okay, where in the fourth quarter should you really be leaning into stocks? And then where on the size spectrum should you really be leaning into stocks? It's about the 19th or 20th day of the month, October, generally carries you through Thanksgiving. Then you tend to chop post-Thanksgiving, then rally again the second half of December. But I think what's notable here is this was the only part of the calendar where you have consistently seen small caps outperform large. So I don't look to seasonality to make a call. I look for it to tip the scales. So we already have small gathering momentum versus large. I think this tips the scale further in small caps favor. And, Guy, I think you've noted it. We've pointed it out here as well. It's been 4 years since small caps really last made new highs. And what we've seen in the past, they actually tend to do this. They tend to go nowhere for 2 or 3 years, They break out, then they go up 30 or 40 or 50%. 300 on the IWM is our target, and I'm sticking with that.
Big move. This one I love, this long-term capital, because you have what you're pointing out is how close they've mirrored each other. Then you showed us what happened subsequently, 98, 99. And I think what you're saying is we could see a similar move, if I'm not mistaken, in terms of what the red is. The red obviously being where we are right now.
Listen, I think you always got to be a little careful with analogs because it's not 1998, it's 2025, right? So let's start with that premise. But what you can learn from here is there is precedent for this type of a move off of a low. And, last week, ironically, was the 6-month move off the low, October 8th versus April 8th. We're up 35% off the low. That would be the fourth best move ever in 6 months coming off the bottom. If you look at what company you're in, it's 1982, it's 2004, it's 2009, 2020, 98, 2011. Strength generally persisted in the 3 and 6 months following. So that's really the message here. I know we're up a lot. I know that makes people uncomfortable. Strength has generally beget strength in this business.
Chris, when you talk about those periods, I'm looking off the COVID low to the 21, or it was actually the first week of 22. I mean, we had 118%. And then if you look at, do we want to talk about the end of 23? I mean, if we go from the 22 low to the end of 23 before we had a bit more than a 10% sell-off, that was 21%. If we want to take the end of 22, which was obviously a new bull market, right? If you will, that was an 80% sort of rally. So here we are off the April lows, and at one point we're up 40% in the S&P 500. You just see those sorts of moves. I mean, was it a bull market? Whether this matters or not, I'm just saying the way you're thinking out, because a lot of folks, like you said, there is precedent for all this sort of stuff. But if you do the math of where we were from the lows, the COVID lows, all the way up here, you have like 200%. I mean, so is that typical over?
It's a great question, Dan. And I think it's difficult to look back from February 19th, the high, to April 8th, the low, and say it was a proper bear, a proper cycle resetting event. I think it was man-made down. It seemed to be man-made up. Whether that matters or not, I'll let others decide. But one of the reasons I feel that we're kind of still in the same cycle, because the leadership that predated Liberation Day has largely been the leadership that has shown up on the other side here, right? So there hasn't been some massive shift in what was working, and that would be unusual for our new cycle. Right? Typically coming off of a low in a recession, you'll get all the economic cyclicals really starting to fire. You'll get all the garbage starting to work. That really has not been what the last 6 months have been about. It's been a continuation of the very powerful leadership themes that were in place. What I think we ought to be on guard for going forward is what could shift or what could change. And something we always say in our work, macro is attempting to figure out how wide is the gap between what should happen, right, your base case, versus what could happen. All the things out there that might be important that you just haven't focused on yet. And that's why I want to pay special attention as this market rallies into 4Q and we think into the first quarter of 26. Does the leadership start to look different? Do we start to get a message that something out there is actually changing? What I want to be on guard for is a more defensive leadership tone taking shape. We've already seen healthcare inflect here modestly. Does that begin to bleed into staples? Does it begin to bleed into REITs? Would that be the message that, hey, actually something is finally starting to evolve here?
Take a look at gold, because you brought some charts and you started it with gold is going parabolic, and manage your exposure in there. And this is going to bleed into your charts in terms of the US dollar, and then subsequently in rates. So I have some thoughts on this, but I want you to sort of walk us through, because gold, obviously, listen, you'd been talking about it for a long time. Now everybody seems to be talking about it, which can historically be a scary thing. Tell us what you're seeing here.
Yeah, a couple things. I would say I thought we've done a good job here the last 2.5 years. I've done less of a good job the last maybe 2 weeks, meaning this was a very orderly bull market for 2.5 years. I began to get uncomfortable maybe 10 days ago. This started to have that parabolic look to it, that parabolic shape to it. Now, that hasn't prevented it from going higher, so maybe I'm early. But when you start getting, 25, 30% above the 200-day moving average, as what it currently is, it has generally put you in the ballpark of some type of a blow-off or consolidation or correction. So I do think we need to start managing our risk around that. Last week, Guy, the GLD did nearly $50 billion of dollar volume. That is a record by a mile. The call volume last week, we did something like 2 million calls one day. That also is a record. There were 3 articles back to back in the Wall Street Journal the last 2 days about people quitting their jobs to go mine gold. So you're in that moment. I don't know if the next $150 is up or down, but I think you need to manage your risk here.
You gotta share that link. I did not.
That's good, right?
I did not see that link, but there's a lot of folks left to mine Bitcoins a few years ago. A lot of people. I remember in the late 90s, Chris. I don't know if you were in the markets then.
Yeah.
I had so many friends who were in law school or actually practicing law or were doing whatever the hell outside of the financial markets to go trade stocks on E-Trade. I mean, matter of fact, or go to some of these prop shops or something like that. It feels like this gold headline is about as bad as it could be. We also saw this in real estate in the mid 2000s. I mean, look, the list goes on, of these sorts of things. They always pop. I'm not telling you gold is very different. Well, it might be very different, but then some of those other,
And I think, Dan, what's interesting about the last couple of weeks is it's been accompanied with dollar actually rallying. Right. So, in what has become I think a pretty unstable price move over the last week or so, it's also accompanied with that other change, some life from DXY, which is notable.
Yeah. Let's take a look at those charts real quick because, you brought them. This is the last few weeks. DXY has rallied alongside gold. Now, one of the reasons I know this, the dollar rallied, it was some sort of, perceived flight to quality on the move on Friday. But this has been this rounding bottom now for a while. So walk us through this, and then yields, obviously, the next one we're going to need to look at.
I mean, dollar really hasn't made any sustained progress lower, basically, since late spring, early summer. So we're 4 or 5 months kind of into some basing in dollar. I don't want to get too over my skis and kind of come out with, this is some major turn in dollar, but it's certainly a change from what I think the consensus is or where the consensus has been talking about. And the positioning would still suggest everyone's short. So if you look at the CFTC data, now a little delay there because the government shutdown, we're actually not getting up-to-date data here. But as of 2 weeks ago, you still had the biggest short position in DXY futures that you've seen since late 2020, early 21. All of our proprietary sentiment work that we do would suggest people are still pretty beared up dollar. So listen, it's not that must mean you must bet long dollar, but you must be on guard for changes. And I think quietly DXY back above the 50-day. I think it can go to 102, 103. I think Euro could probably go down to 112. Those aren't real big moves, but they're important if you're super long gold or super long silver.
That's right.
It can cause some type of a correction there.
And we have questions about silver, which we will address. But now let's look at yields because, all 3 of these things historically obviously have been connected.
Yeah, down, 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 down is how I would describe yields here. And it's funny. I think the best opportunities in this business is when people will not acknowledge what's going on right in front of them. I mean, all year, all you heard about was, how the tax bill was going to blow up the deficit and yields would go higher, or what was going on in France or Germany. I mean, yields have not gone higher despite any of it. And now you have 10s breaking down. You have some very, very modest support around 4%. Ultimately, I don't think it holds. I think we're looking at a 350 to 375 10-year yield. I think we're looking at a 3% 2-year yield. And maybe most importantly, Guy, the long end is starting to thaw here as well. And you're seeing it in Europe, right? German 30s have come in, French 30s have come in. So this seems to be part of the story. So then let's ask ourselves the bigger question. Is the equity bubble really going to pop with yields down? That sounds unusual to me.
Yeah.
No, it's okay, Dan.
But it's not, so yields down. And let's just say the dollar, sticking around here, not doing that breakout meaningfully above 100. I mean, you would think that those are tailwinds for corporate earnings.
Yeah, you know what that sounds like? That sounds like capital being attracted here. And the irony is the start of the year was all about the death of American exceptionalism and the end of the U.S. I mean, the U.S. bond market's been the envy of the world this year.
Yeah.
Right.
Yeah.
So I think we got to look at the price action and say, okay, where's the narrative? And does the price action either confirm or refute the narrative?
Yeah, but I mean, the end of American exceptionalism, we saw what happened in April with,
Sure.
with this, I mean, we did have the sell America trade. You had the dollar come in, you had yields initially go down, but then, obviously meaningfully go up. And that means, selling of treasuries. Last piece of this puzzle is crude oil. It has not been able to catch a bid really, It's this very well-defined downtrend, a series of lower highs and lower lows. But again, weak oil is pretty good for a lot of our industry.
Well, Dan, I think here's the big question, right? If we're trading this, I would say, listen, trend is down, trend has been down, stay negative, stay short. Maybe there's a little light in some energy stocks, but on balance, the trend in crude is lower. But the bigger question is, listen, we have lower rates and we have lower oil. Those should be stimulus for consumer. Right? We should see discretionary respond to that. The information, I would say, is if it doesn't, right? I have every anticipation that it will. We know we have stimulus on the consumer front coming in early 26. We believe it's going to be a very good tax refund season. We have lower oil and lower rates. It's time for discretionary to start responding to that. If it doesn't, I'm missing something, right? So that, I think, is the value of thinking about crude and rates kind of as consumer stimulus here and seeing if the stocks can respond to that.
Yeah. All right. That's a good one. We've been keeping an eye on, on energy stocks as it related to it, crude, but that's a different story. Before we get out of here, Chris, we want to hit the strategic macro. This is your momentum fund ETF. You launched it last year. I think when you launched it, you were last on here. Again, this is a small ETF that is to mirror the work that you do. And so give us a sense of this thing, because it did break out to new highs of the construction, how you move the weightings around. It looks like an equal weight, because if you think about momentum, when you look at what's in there, it's not just tech. A lot of folks think about momentum and they think about tech stocks.
Yeah, that's right. That's right, Dan. It's been about a year. Ticker is SAMM, Sally, Apple, Mary. What is the goal here? The goal is to basically kind of run it almost as kind of a hedge fund product where I can be entirely long, entirely in cash, entirely in gold, entirely in bonds, kind of with the idea of benching against zero and trying to capture wherever the momentum is migrating to within the macro. And there are times where that's heavier equities. There's times where that's heavier gold or heavier bonds. When I look at how I'm weighted today, a lot of financials. We've been very fortunate the last couple of days to be here with Bank of America and with Wells. We've been with Goldman and Morgan Stanley the whole way up. So certainly comforted that those continue to validate the story. Very bullish power stocks, the CEGs and the BWXTs and the CCJs. I mean, all those power derivatives of the AI story are still validating the AI story. So still there. A modest cash position here, about 5% cash, which is generally kind of how we like to run. It gives us the opportunity to be nimble when names come in. But really the discipline is adding to leaders and quickly jettisoning things that are starting to weaken, particularly relative whatever benchmark you might have. So power, banks, we've been fortunate to be on the right side of the crypto stuff for much of the year. That is kind of the focus here. And I think, listen, as we look out to 26, I could see the world changing. And I'm glad I have the ability and the luxury to get bigger in cash if I need to, or bigger in bonds if I needed to. We've been adding to Japan here as well, so it can be global. We're trying to capture where the momentum in the market is and where the momentum in the macro is.
Well, you do a great job at it, and you're nimble, and that's why we love when you come on Fast Money. We obviously love having you here. Thanks for your time. And, you mentioned just real quick, Amanda can throw a Constellation Energy chart up. I mean, you brought that name a while back. Tim Seymour talks about it. I've brought it up a number of times. That stock made another all-time high today, I think north of 410. It's a little lower. It's lower on the day, still up on the day, but this has been a monster. And, that whole space, people are not paying enough attention to. So I'm glad you brought it up on this.
Guy, just, let the market tell you who the leaders are, right? Let the market do the work for you.
Yeah. Chris Verrone, that was awesome, man. We hope you will come back soon. We appreciate all the hard work. All right. That is our main man, Chris Verrone, partner, chief market strategist
Chris.
at Strategas guy.
He's I think of him as a young man, like the rest of us, he's getting older as well. But, like many of the people that we try to bring on, they do really rigorous, thoughtful work. And, whether it's Carter, whether it's Chris, we've had Katie on, right? I mean, if you think about that, we had a lot of people that come on and, talk about the things they do. We obviously have Doug Cass in the background talking to us every day. And, again, you don't have to agree with these people, but you have to definitely respect the work that they do around the edges for sure, Dan.
All right, let's go back to the S&P futures here, guy, the E-minis, because we're talking about that prior high. We still haven't taken it out. I mean, every other day since Friday, we've seen just a sea of green. We know what's driving it. We'll hit some of this AI sort of stuff. I mean, let's do a 1-month chart here really quickly, Amanda, because we see that gap going back to early September. And, it really seemed like something that was going to, at least test, guy, when I look at these bars, okay, just to be clear, people, the left is the opening. The right tick is the close of the day. And it's interesting that you see on Monday where we closed, you see on Tuesday where we opened, and then you see where we closed, you see where we opened today. Like if we were to get a close, guy, below 6,700 back near that little cluster of closes, does that mean anything to you?
It does. I mean, the day obviously you're looking at is Friday. I mean, the action there now, it's not a textbook engulfing pattern, but it's damn close in terms of where we opened, where we traded up to, and obviously where we closed. And now you've had a series of what we call inside days, which I guess is sort of interesting. The market is sort of chugging along, but you look at this and then say, okay, what did Chris Verrone just bring with us? Well, he said that gold, manage your positions. There might be some profit taking, so be wary of that. He looked at the US dollar, feels like it's been making a base for quite some time. He's right. He's not saying you have some huge breakout, but he could see the dollar higher. And obviously he talked about yields at the end, and he continues to think the yields go lower. So ask yourself, under what set of circumstances does that happen? And you saw a glimpse of it on Friday. What I would submit is if you were to see another prolonged period of time like you saw on Friday, that will make the dollar go higher in a flight to quality. That move will derail gold in the short term because gold is not impervious to bigger moves in the equity market. And to a certain extent, that'll probably help the bond market in the same way that it helps the US dollar. So, for me at least, when I see the work that Chris did and try to figure out how we get there from the equity market selling off. Now, again, I'm not saying I'm right, but that's how my mind is working right now.
Yeah, I think, though, if we get a close below, let's call it, I don't know, 66.80 or something, guy, below this like series of closes over the last few trading days, I think you want to kind of press the market here a little bit. And, I just want to go back to this kind of Gen AI trade. And it's interesting to me what I'm seeing underperforming today. It's the Amazon, it's the Microsoft. Again, we've been highlighting that. I do feel like Microsoft on some sort of weakness will be pretty interesting to me because it hasn't been in the center of all this euphoria, over at least the last, few months or so. But, man, Oracle, okay, like they give some huge order to AMD. Well, do they have the money just yet? They raised a bunch of, debt and all that sort of stuff. And, AMD guy is trading up 8% right now. And Oracle is also one to me. AMD and Oracle have had these two huge gaps, right? Over a lot of the same sort of kind of announcements that we're seeing all over this place. Go back to Oracle for a second. We put on a trade a few weeks ago when Oracle, after that sort of gap, and maybe we were kind of a little early, and I don't mean a little early because normally what I'm saying from a trading rule, you don't want to fade that sort of strength. Well, we did. After about a week after that gap or a little more, I think the stock was like 320 guy, and we got it down to like 280. And what we were doing is targeting a 300, 250, and that's that gap. If you see it, kind of level. And we used a put butterfly. You could have used a put spread. You could have bought outright puts. You could have sold calls or call spreads, against your thing. We chose a put butterfly. And that's something, guy, I think I'm going to put back on, especially as you see the stock had that move higher, and then let's see where it closes today.
I agree with that. Well, first of all, you have an S&P that's given back like 30 handles ish since we've been on. So that's something to watch. I mean, today could be one of these fascinating days without question. AMD, if you really want to get down to brass tacks, it's been this little lion man over the last couple of weeks, this stealth rally.
Whoa.
What happened?
That was probably the third song Mumford's played last night, Little Lion Man.
No kidding.
You could go to the setless.fm and they will tell you what they play. I think it was the third. Jacob, can you do? Yeah, so let's see what else you got. But
well, I got a lot for you if you
yeah, let's do it.
Well, I've been a bit of a hopeless wanderer in terms of trying to navigate the market.
They played that too.
But I do believe in a couple different things. I watched Brad Gerstner this morning, and he wasn't speaking about me or to me, but he might as well have been, because what he said in terms of what you just mentioned, do these companies have the money for the spend? His point was you're hyperventilating a little bit because you have to sort of forecast out to 2030 and what are the revenues they're going to have by then. And it's not as far-fetched as people like Guy Adami, he didn't say that, have been pointing out. Now, that could be true. Remains to be seen. So he is not as exorcised about the circularity of this spending as people like me. And he knows a lot more about this stuff than I do.
The guy's brilliant. I know him personally. He's not only a great public markets investor, he is also a great VC. And, very few people do those two things well together. He has a B2G podcast with Bill Gurley, who's also a legendary VC. They get amazing access. I think we highlighted a couple weeks ago, Jensen Huang, they sat down with. The only problem with that thesis, and I talked about this after I was at this kind of VC private tech event last week, you cannot find a single person in tech, okay, not one, maybe our friend Roger McNamee, who are actually think this won't continue to go on, who actually think the Bain study and the McKinsey study and the list goes on and on about what we will see in the revenues in 2030 across the entire landscape relative to the CapEx build. And when you see this sort of behavior right now, Guy, in the public markets, you see there's a headline in the information today saying that Anthropic, okay, which has the Claude, CLAUDE, LLM. This thing's, I think, valued over $60-70 billion in the private market, when the headline was that they're about to go on their acquisition spree, their startup acquisition spree, further pushing up these valuations, doing these acqui-hires. Sooner or later, listen, I don't give a shit what people say about the bubble in the late 90s, and I've been saying this, that it reminds me, this environment, more than 2020 to 2021 rather than 99 to 2000. Very soon, I'm going to flip that, because what went on in 2020 and 2021, some of the biggest names participated, but it was all the other crap, right? It was NFTs, a lot of the crypto stuff. It was SPACs. It was, recent
Bored Apes.
Yeah, like all this crap. Okay, so my point is, now it's not even the meme stuff. It's only the AI. Yeah, the banks have a ball, these things, Wells Fargo up 6%. They're just not a big contributor to the S&P. So this leads us to our main man, John Butters. He is the senior earnings analyst at FactSet. He writes the Earnings Insight blog every Friday morning. You can get it at factset.com/insight/subscribe in your email box on Friday. But John is very, very generous to provide us with a preview of it. And we do that on the Market Call, Guy, on Wednesday. So walk me through a little bit of John's focus today.
Once again, first of all, we love John Butters, as you know, and we will have him on IRL, as the kids say, soon. But with that said, this isn't just another way to look at sort of the top heaviness of the market. And the 7 stocks we talk about all the time, earnings growth of basically 15%, which is staggering. The flip side of the coin is the other basically 94% of companies ish out there, earnings growth of about 6%, 6.2%. So this theme continues in terms of stock performance, and it continues in terms of earnings and earnings growth. And It's gone on a lot longer than I thought. At some point, I thought you'd see a bit of a baton pass, but we're not seeing it here. And John Work suggests that, Dan.
Yeah, and the point I just make in juxtaposing to what I just said about, we're increasingly looking like 99 and 2000 from somebody who over the last few months is saying, you know what, that bubble it can continue to inflate for a very long time, and none of us know when it's going to pop. But when it does, I think it has the potential to be far worse than what we saw in the early 2000s. And I'm not saying we go into a protracted bear market like we did from, the highs in 2000 to the lows in 22 or 2002, which was excruciating. If you were in the markets back then, there was no low enough in 2000, and then in 01 and 2002 was excruciating. It was the worst year because there was no optimism about when the stock market would bottom, which was somewhat different than what was going on in the economy. This is so financialized, guy. This is far closer, I think, to the housing bubble and the popping of that. There will be companies that go out of business. It might be CoreWeave. It might be Oracle not going out of business, but left in purgatory the way it had been, you know what I mean, over the prior whatever years. And just to put a bow on the Brad Gerstner thing, Brad, when he was on Fast Money from iConnections back in late January, he and I, before he went on the show, we were talking about Oracle. That's what he wanted to talk about. I'm like, what are you talking about? I said it respectively. This is like the distant fifth in cloud. It's got 4% market share, yada, yada, yada. I mean, he's a guy who saw this, but the only thing I'd say about now is when you have everyone leaning into these 2030 revenue thing after there's no doubt about the CapEx bill and how they are funding it. Today, there was another deal talking about like a BlackRock funding one of these, it just keep going and going. And my concern is that all of that debt that may end up being kind of shitty is going to find their ways into ETFs, and they're going to find their ways into mom and pop's 401ks. And you're also at a point, because of the concentration, because of what Butters is mapping out right here about the earnings growth and where it's coming from. And it's not just the earnings growth, but it's also the performance of the markets. That's when things get dangerous. So the more this bubble inflates, I think the worse the aftermath is going to be. And you can kiss 2030 revenues out of the water, because if these companies have been misallocating capital in a way that it's circular and that it's found its way into the financial system, not just the economy and not just what's going on with these individual stocks, then we got a problem, guy.
Well, I will wait for that to happen. And when it does happen, Dan, I hope somebody awakes my soul, because it's going to be important, as is John Butters' work. See what I did there? By the way, a lot of the things that you just mentioned, Andrew Ross Sorkin was on Fast Money last night, and he was, again, he's not saying there's a perfect correlation, but said a lot of the things that we're seeing now, we actually saw 100 or so years ago. And I'm looking forward to reading that book. It's a big book, which is problematic for me, but I think it's one of those books you have to read.
Well, Guy, we're going to download the Audible, we're going to go to the application store. We'll put it on your iPhone. Maybe we'll get you some sort of headset and you can listen to a very long book. You missed one opportunity. You said, I will wait. You did say this, right? What did you say then? You said,
and when it happens, I hope somebody awakes my soul.
Okay. But then you could have said, from my place in the cave, because the
cave is a song that's off of Sigh No More, I think, if I'm not mistaken.
Dude, I'm gonna make you a playlist. I mean, like, this is a great band and they're a fun band. And Guy, I think I'm gonna drag your ass to see them someday. All right, John Butters working overtime for us. The top 7 first, the 493, differentiating that earnings growth. We know the story here. We appreciate Butters. He is going to be popping in throughout earnings season with some great work. He's kind of like our Sherpa during earnings season.
He's our Tenzing Norgay, no doubt about it. I mean, without question. I know you know him. By the way, I know she's not watching before we get out of here, but Elizabeth and I did a show on Monday, which we often do. And I asked her how she felt about this series coming up with the Dodgers of Los Angeles. And she obviously felt good, as she should. But she also mentioned that the onesie that Griffin has been wearing, the Milwaukee Brewer onesie, they left out in Long Island. They didn't bring it and he had been wearing it every time he wore it, the Brewers won. And I said, "Are you out of your effing mind?"
Yeah.
I said, "You should get in a car right now and go back and get it." "Oh, I'm not superstitious." They're down 0-2 going to LA.
I mean,
I hope if Elizabeth's watching, I hope she gets her rear end in a car and picks up that onesie.
Yeah, well, you know, the Risk Versal Media, we were all over the Milwaukee sports ecosystem for Griff Riv. We love that little guy. All right. Thanks to Chris Verrone.
Yeah, you know what? That was great.
Thanks to Guy Adami. Maybe, you know, my voice is a little roughed up. You know what I mean? We had a big night there, but we'll be back tomorrow, Guy, on the Market Call. Check out some good stuff. Risk Versal podcast on Friday.
Killing it.
We got a huge one. We got Danny Moses. We got Vincent Daniel. We got Porter Collins. We got Guy Adami. Me. That's fine.
In the same room, we're going to be sitting at a table together.
Have we ever had 5 people on a podcast? I don't know if we have.
No, we're going to give it a shot.
Well, Bill's going to have to figure that out. He's going to, you know, work a little bit.
Where's Bill? And Bill working tonight, or is he taking the night off? Bill?
Well, you guys can find him at Billy Hockman on the Instagram. He is one funny young man.
You know what? Honestly, he's really funny. He is.
Go follow him. If you're in New York City, he'll put all the stuff. It's all on the Instagram where he's playing each night. I've gone a few times. He's excellent. Go check him out at Billy Hockman. Hey, Amanda, which I know she's doing what, Guy?
Yeoman's work. And by the way, Amanda is doing great.
Well, that's what I was going to say.
Yeah.
You know, go follow Amanda. Follow our main man, Jacob Hallex. Go follow CC Lagater. Go
blow up their inbox.
Fire Timmy Adami. Go fire Timmy Adami. And go
blow him up.
Yeah, blow him up.
Amanda put a picture. I don't know if I'm allowed to say this. I have no idea. But she put a picture of her daughter on Facebook, the baby. Stupid.
She's got 2 beautiful kids, by the way.
She does.
Yes. Yeah. But
well, our husband's very handsome. So
yeah, Danny. Without doxing him. All right, everybody. We'll see you tomorrow. Thanks.